We get a fair number of phone calls from agents who ask us if we have leads that will help them get in front of more prospects. And we probably get 3 or 4 calls a week on this. And our answer is consistently yes. We do have leads, but not in the traditional sense, because the best leads that we have and that we see come from marketing to business owners. Hi, my name is Dave Donchie with Leisure, Werden, and Terry. Thanks for joining us. And joining me is my associate, Victor Paz. Hi, Victor.
Hello, Dave.
All right, great. So today, in just 20 minutes, we're going to share with you some of the best ideas that you can hear to get in front of business owners who generally share the same concerns and they have the same exposures when they're trying to run their business successfully. And solving many of those problems can be done with life insurance. Our special guest today is Dan Hardy from Principal Financial. Dan's been in the financial service industry for about 10 years now, since 2009, and he's got a bachelor's degree in marketing from Iowa State University and an MBA from the University of Iowa, and he also holds the CLU and CHFC designations, which is pretty impressive. It's a good commitment to our business. Dan's our regional vice president in the life business solutions area of Principal Financial and focuses on the design and point of sale support for business life insurance plans and business exit strategies and key person retention strategies. An interesting side note, Dan is also an Ironman triathlon competitor, which is pretty impressive to say the least. So welcome, Dan.
Hey, thanks, Dave. Happy to be here with you.
Thank you. So let's talk about some of the life insurance opportunities that can be found in business insurance markets.
Perfect. Yeah, today's topics are very front and center on the minds of business owner clients. It's something that really over the last several years, we've been getting a whole lot of activity, a whole lot of questions, and a lot of plans being implemented for buy-sell strategy. So just thrilled to be able to speak with you about this here today. We can go to the first slide here, if you wouldn't mind, Dave. As you see here, there are a number of different types of buy-sell agreements. I always like to say there are really only a couple of ways to sell your business if you're talking to a business owner client. There's selling from a position of power or selling from a position of weakness. And some of these strategies here, these buy-sell agreements, are going to help those business owners sell from a position of power versus having to turn to the open market and potentially plead to the outside market to purchase their business. So these are 4 of the most common methods of buy-sell agreements that we see. The cross-purchase agreement, there are benefits, there are considerations with that structure. The entity purchase agreement, the wait and see, which we'll spend some time on here today, and then one that is maybe a little less known, but definitely has a lot of benefits, is the business continuation general partnership. We see a lot of activity there because it does have a multitude of benefits in structuring a agreement that way. From a cross-purchase standpoint, I'll just highlight that. We're not going to spend a ton of time. I think everyone on today's call is aware of how that structure is built or designed. But in a cross-purchase agreement, if Dave and I were business partners together, as an example, I would be the owner and beneficiary on a life insurance policy on Dave's life, and he would be the owner beneficiary on a policy on my life. So if I passed away, Dave has a death benefit that's payable to him tax-free. And in that cross-purchase agreement, he's mandated to use those death benefit proceeds to buy my spouse and to buy the shares of that business from my spouse. In doing so, he gets a step up in basis, and I'm effectively, and my spouse is effectively out of the business as well. From an entity purchase agreement, rather than having the policies owned by or cross-owned by each of the partners, we have the policies owned by the business. Now, with cross-purchase, it's nice if there's just 2 partners, but if you magnify that to 10 partners, I'd have to have a whole lot of policies funding that agreement. So the entity purchase agreement is an effective strategy to have 1 policy on each partner owned by the business, again, with the death benefit payable to the business. The business buys that deceased owner's shares from the former owner's spouse. The wait and see agreement and then the business continuation general partnership we'll dive into here on the next slides. So we'll go ahead and jump forward.
Sure, Dan. Before we do that, we get a lot of calls from producers, and they ask us which type of agreement the clients should use in terms of purchasing life insurance. And I always suggest that the agents not answer that, but provide information to their clients and let the client's legal advisor provide the answer as to whether they should do cross-purchase or entity purchase or some other form of an agreement, because I think the agent can get in trouble from a liability standpoint later on down the road.
Yeah, Dave, that's a great point. We can provide some recommendations and considerations as to the various strategies, but we would never say this is the best fit for your client or you should go this route. Really want to be have a seat at the table as an advisor in implementing a strategy that's best to fit that client's needs, because we all know that no one client is the same as another client. So we want to make sure we position that business buy-sell arrangement to effectively meet the specific needs of that business client, obviously in partnership with the rest of the team that's there to structure the agreement for the business owner.
Right.
So on this slide, you'll see here kind of the basic question that you should ask business owners is, to whom will you transfer or sell your business? And I've had a lot of times where one business owner is of the mindset of going one route, and another owner is of the mindset of doing something completely different, especially in family businesses. So this slide, I think, does a nice job of just opening the door to both family and non-family businesses, what type of strategies and how to structure that buy-sell may be available to them. There are obviously a lot of different ways to sell your business. This is just a good slide to help identify which may be appropriate for them, or at least options for them. Steve, we can jump forward here to the next slide. So what should be included as a trigger event in those buy-sell agreements? And you'll see on the screen here a lot of different items. I've simplified these down to the 5 Ds. So the one that's typically addressed in buy-sell agreements is going to be the death of a business owner. Now, the next logical D is the disability of a business owner should also be one of those mandatory triggering events, and it should be clearly defined what that disability trigger is. If it's the loss of a limb, if it is the inability to work for 6 months, what exactly is that disability? Should define that in the buy-sell agreement, as well as make sure that it lines up with the product that's funding that buy-sell agreement. So the disability product that's there for the funding amount. So we've got death, disability. You also see on the screen there, divorce. That's going to be one that's quite often missed. There are some famous cases of business owners that are now in business with their former business partner's spouse, or even the former business partner's spouse's new partner. So again, those are some risks that can really be mitigated through an effectively drafted buy-sell agreement. Death, disability, divorce, the departure of a business owner, and the dissolution of the business are the 5 methods, or the 5 Ds that we're typically looking for in buy-sell agreements. Now, the departure of a business owner can mean quite a couple of different things. It could be the voluntary departure of that business owner by way of retirement. And what exactly is retirement? Is it working 20 hours a week? Is it seeing 5 patients a day in medical practices? It should be defined in that buy-sell agreement. And then the other departure that we're looking for in an effectively drafted buy-sell agreement is going to be if there's a forced departure. So the loss of a medical license, or the failure or disbarment would be another item, or just something that a business owner that did something unethical should also be a mandatory sale event for that departing business owner.
Dan,
so these
let me ask you a quick question. When you guys review when we provide you with copies of agreements that producers might get from their clients, and you do a review, you're looking for these different triggers, are you not?
Absolutely.
Okay.
So when we do a buy-sell review, we're really trying to make sure that those 5 different triggering events are covered. And we cover them in a little bit more detail in that buy-sell review. And oftentimes we're finding that divorce is the one that's quite often missed. So that's one that you should definitely review if you have a buy-sell agreement that doesn't have that covered.
Thank you.
Yeah, no problem. So we can jump over to the next slide. So here is, at long last, the wait and see buy-sell agreement. And this is one that is a little bit less common, but I think provides a lot of flexibility for businesses. So in this buy-sell strategy, you're somewhat employing the cross-purchase method of buy-sell agreements, as well as the entity purchase buy-sell agreement. So in this type of arrangement, the agreement would stipulate that if a partner passes away or leaves the business has an option to buy that owner's shares. If the business decides not to, then the remaining partners have the an option to buy those departing owner's shares, or the departing owner's share.
Dan, comment. This is Victor. How are you?
I'm great.
So you mentioned that in a wait and see approach, there's a couple of options, and that is for the corporation or the business to buy the shares from the one of the partners, the exiting partner, let's say, and the other option would be for the existing owners or the balance of the owners. They also have that option of purchasing those shares, right? So it's kind of a two-way approach.
Yeah. So you kind of have three different steps. So first step is the business can buy those shares. If the business does not, the partners then have that option to buy those shares. And if they choose not to execute that, then it goes back to the business, and the business is mandated in the agreement to buy the remaining shares, just so that partner is not still having his shares outstanding. So it's kind of you have some flexibility in that type of an arrangement.
Thank you.
Yeah, no, absolutely. Now, the question commonly comes up is, well, where is the life insurance owned in that agreement? And the mandatory purchase is held at the business level. So many times the business, most oftentimes the business will be the owner and beneficiary on those policies, so that they are able to fulfill that mandatory obligation to buy the departing owner's shares. So most oftentimes it's maybe a partner that wants to have a bigger stake in the business that exercises that optional purchase of that deceased owner's shares with personal capital. Any questions on the wait and see buy sell? Dave, Victor, anything to add on that one?
No, let's proceed.
Nope.
Makes sense.
Perfect. Yeah, and the agreements there, one of the nice things about working with LWT and with Principal is we do have sample agreements for you. So if you say, yeah, we've got a client that wants to do a wait and sell buy sell agreement, but their attorney hasn't drafted one of those before and doesn't know exactly where to start, you're able to provide that attorney with a sample agreement for the wait and see buy sell or any of the other methods of buy sell agreements, so that they can have a starting point versus having to draft it from scratch. So it helps with a comprehensive buy sell strategy, as well as it cuts down on those billable hours of having to start from scratch. So we can dive on to the next slide here.
Resources. Excellent. Good resources for our producers.
Absolutely. So another strategy here, and it's quite similar. We see this with a lot of law firms and CPA firms as an example, would be the multi-owner buyout. And it is a really entity purchase agreement, but it's funded with cash value life insurance. So the nice thing about that is that there is an asset on the balance sheet, typically a higher cash value product, to minimize that balance sheet impact. But there is cash on the balance sheet of the business, so that the business can not only buy out a partner at death, as you'd see with term insurance, for example, but also be able to buy out one of those partners when he or she leaves the business by way of retirement. So the multi-owner buyout, we see this a lot with firms in the 15 to 45 partner range, and they're fantastic sales, typically issued on a guaranteed issue basis with cash value policies in this type of an arrangement. Victor, Dave, anything to add on the multi-owner buyout?
Well, I can say
just
that
one,
we did have an experience where a producer had quite a few partners in a law firm, and they were using term insurance. And the problem with term insurance is it runs out. And they didn't had they used some cash value type of life insurance policy, they would have had the ability to buy out those interests and pay survivor benefits later on. But that's the downside, of course, of term insurance is it's a limited time to protect the business and the partners, but eventually they're going to have to pay up, and it's going to be a lot more costly later on when that term duration does run out.
the other, this is Victor, the other comment I have on that is when you're using cash value life insurance, whatever it may be, is that it's planning too late is going to be monumental. You're going to be catching up. So it's always best when you're using cash value life insurance to plan early. The earlier, the better.
Yeah, great point. And the other thing, I think that it's best practices to do that early outset planning. That's incredibly important. But another reason why you should be talking to your business owner clients about this is, especially if they're C corporations, is because of the reduction in corporate rates, companies are sitting on potentially higher savings account balances or larger assets on the balance sheet. So you can somewhat reposition some of those cash assets that they've had because of corporate tax rates being lowered from top marginal of 35 to a flat 21%. You can now reposition that cash into a cash value life insurance policy, which is a cash equivalent on the balance sheet, and it provides them with that protection if an owner passes away, and provides for that funding of the buyout at a departure of a business owner. So again, it's a strategy that is top of mind and a good idea to discuss with those C Corps as you're working on their buy-sell strategies. Dave, we can jump to the next slide here. So another thing that's very top of mind with business owners today is key employee retention. So the labor market is quite hot right now, and I'm sure many of you have heard that. It seems to be on every different news publication and talk show that your financial talk show that you're watching these days. But I'll just share a couple of highlights on why the labor market is so hot. Unemployment is at historical lows. 3.8 to 4% is what it's fluctuating between, which it hasn't been that low for about 50 years. There are currently more job openings in the U.S., 7.3 million, than there are job seekers in the U.S., 6.3 million. And then lastly, the Department of Labor measures something that's called the quits rate of employees. And that measures the number of employees that quit their job in any given month. And that number has been fluctuating between 2.3 and 2.4% of the U.S. workforce. And that's the workforce. We're age 25 to 54, is not including retirees, which is a common question that pops up. So key employee retention is a pressing concern for business owners because of those collisions of the stats that I've shared. So many times, especially if you're looking at a law firm or you're looking at a smaller business where there may not be a ton of partners in that smaller business, many times the best option to sell the business is not turning to the open market where you're selling from that position of weakness that I shared earlier, to actually structure the agreement where you're selling it to a key employee. So you can implement a plan that not only retains that key employee to meet that retention need, but also does double duty with those dollars of providing the owner with a market, a tangible market for their business, an established market for their business in 10, 15 years in the future. And that kind of goes back to Victor's earlier point of the best time to start these types of plans is early versus waiting till the last minute.
Good point.
In the select buyout option, I'll just walk you through high level how this works, because I do think there are a lot of tangible benefits that you can see. In this plan, it would be similar to an executive bonus plan, which many of you have worked on in the past. It's a personally owned policy by the employee, paid for by the business. And typically the business is grossing up for taxes on that plan. The business gets a full deduction for the premium as well as the gross up for taxes. And the employee has taxable income, but again, we've grossed up, so the employer is paying the tax for that employee. Now, we typically, in the buyout option, we typically would structure it so that the minimum non-MEC face amount is high enough so that the employee can also make a contribution to that policy. So as an example, $10,000 goes into the policy by the employer, $5,000 goes into the policy by the employee. In 10, 15 years in the future, the employee accesses all of those policy cash values to buy an interest in that business. So it's a nice way to sell the business, especially in some of those smaller firms, or like I said, where you have someone that you know will be a partner in the future. We can move on to the next slide here. Business continuation general partnership. I know we touched on this earlier. This is a little bit more complex strategy. Again, we would establish a partnership or an LLC. If you have multiple owners, you would have the equal percentage ownership of that partnership as of the business itself. Each partner would make an after-tax contribution to the business continuation general partnership, or that partnership LLC that we talked about. That partnership would then purchase one policy on each of those partners. The nice thing here is that it meets the buy-sell need, but if they don't have one of those partners passes away, you can easily distribute the policies to those partners without any additional tax. So it's kind of a combination of buy-sell planning and supplemental retirement income planning for those partners. We could jump to the next slide.
There's a benefit in it. Yeah, so there's a benefit in it for each of the business owners to repurchase that interest in the partnership and in the policy. Absolutely.
Again, that's where structuring these, there's no right or wrong way to structure any of these buy-sell agreements. It's what's the best agreement type to fit the various needs and goals of the business. So a sole owner business, we talked about that transition to a key employee that you may do if it's a smaller business and you want to bring in a key employee to be the owner of the company. There are also a couple other ways that sole owners can establish a buy-sell agreement. There's a no-sell buy-sell if it's in the family. So you'd set up a trust that would be the owner beneficiary of a policy on that. Owner's life, if the owner passes away, the trust is obligated to buy the business from the owner's spouse. So the spouse is now out of the business, the trust is owned by the business, and the trustee then is the one that's responsible for running the business and then ultimately selling the business. So that's one way. Again, you still have that challenge of selling the business. It's more so alleviates the concern of the family having to really take over the business at a time where they may be struggling with the loss of that family member. A one-way buy-sell, again, is with a key employee. The key employee would be the owner beneficiary on the life insurance policy of that sole owner, and would sign an agreement that would mandate him or her to use those death benefit proceeds to buy that owner's interest and ultimately become the new owner of that business. So again, that's a question that comes up a lot as well. It's easy to structure a buy-sell with 2 or 3 partners, but how do you structure one if you don't have a partner? These are just a couple of ways to do that. We can move on to the next slide here. An employee stock ownership plan is a good way for certain types of businesses. I would say that rather than selling to one key employee now, in this arrangement, you're selling to all key employees. It's a qualified plan, so there are some benefits in an ESOP. The things I would tell you to look for where this may be an option is if the business is valued at $3 million or greater, there are 30 employees or more, and they have profits of $300,000 or more. That's going to be where it may be a fit for an ESOP. We're happy to help you with that transaction. Move on to the next slide here, please. Really, the funding of the buy-sell is something that's quite startling. When we do these buy-sell agreement reviews, most oftentimes we're finding that there's something in the buy-sell agreement that is either outdated or was frankly just missed, or maybe there have been some changes in the business and the buy-sell agreement wasn't updated. the value wasn't changed, whatever it may be. But one of the concerns that we find most often with this is that the buy-sell agreement is not funded appropriately. Sometimes it's not funded at all. So these are high level, the three items we're really looking for. So we want to make sure that the right amount of money is available to execute that buy-sell at one of those triggering events, those 5 Ds that we talked about, at the right time. So when one of those things occurs, and the policy or that funding is available in the right place. We see a lot of times where policies are owned by incorrect parties that may result in taxable income and tax consequences really all around. So these are the 3 items that you really want to focus on when you're talking to business owners about their buy-sells.
Dan, because the life carrier underwriters don't like to insure a business for more than it's worth. As the value of the business changes, obviously the buy-sell agreement will start to fall behind in terms of the values. How often do you recommend that a business owner review their buy-sell agreement?
What a great question. We typically suggest that buy-sell agreements be reviewed every 2 to 3 years, or at some change in the business. So whether there be a huge growth event in the business, a new partner leaves, a partner or new partner joins, a partner leaves, those types of items. If they, from a best practices standpoint, for a buy-sell, we would typically suggest not a flat amount of value to be written into that agreement, but rather a funding or a method of valuation included in the buy-sell agreement, so that there's a fair market value established based on that method of value. From a funding of that, we have a couple of options. It's, as you said, Dave, it's seeing if we can have a slight bit of growth factored into that buy-sell from a policy standpoint, or especially if it's an entity purchase buy-sell, earmarking maybe some of the key person insurance that's purchased, which you have some higher amounts, into helping with the funding of that buy-sell in future years. The other item,
combining key person with buy-sell funding to get a larger amount of insurance than you may be able to get if you just did buy-sell funding by itself.
Absolutely. And then the other option would be death benefit option 2. We see that a lot, especially in some of those cash value types of situations. Perfect. We can move along to the next slide. Again, you see here, this is some kind of the harsh reality of the buy-sells that we've reviewed over a 6-year period. It's about 1,500 buy-sells. So life insurance was effectively integrated in only 45% of those buy-sells. And a scarier stat is 6% of those actually had the appropriate amount of life insurance based on a current value of the business. That number also was consistent with the amount of disability insurance that was effectively purchased for those buy-sell agreements. So
those are staggering. Those are staggering statistics, to say the least.
Yeah, it's a huge need for business owners, and especially if you're working in the baby boomer space, where business owners are starting to maybe think about transitioning their business, and they are potentially aging a little bit more. These types of issues really can be devastating to the business if something happens to one of those partners. So move on to the next slide here. So as we somewhat begin to wrap up here, we want to make sure that triggering events are included, those Ds, in a buy-sell agreement. We want to look at the impacts to the value of the life insurance policies themselves, the changes in ownership of the business, and then again, reviewing the buy-sell every 2 to 3 years is going to be a best practice. Make sure that not only is the buy-sell agreement itself up to date, but the funding is in line. And obviously, if you're looking at policy performance of cash value, making sure that of cash value policies, making sure that that is current as well. Jump to the next slide here, please, Dave.
Yeah, I'll jump to the next slide. I want to ask a question to both you and Victor, and that is, a lot of our producers have specialty and expertise in certain areas of insurance, and perhaps the life insurance side is not necessarily that particular specialty. there's a lot of information here. Obviously, some of it's a little more technical, but what can a producer do and say to their business prospects and business clients to at least initiate and get them to open up and start a conversation about these types of plans and this type of business funding and insurance protection practices? Victor, why don't you go first?
Thank you, Dave, and I'm glad you brought that up. You know, if you look at our broker base, like you said, some brokers, some of our customers aren't as specialized in certain areas as others. And but I wrote down 3 questions because everybody knows a business owner. And the first question is what Dan mentioned earlier, which was, do you have a buy-sell agreement? And if so, when was the last time that you reviewed it? So that's a simple question to ask a business owner. It's not intrusive, and it's a great question. Secondly, which is something that Principal does, and I look at Principal as a great Leisure, Worden, and Terry partner that brings us value that we then transition over to our customers, and that is the value of the business. And Principal does a great job and they have a program for business and business valuations. So what's your business worth would be the second question. Those are 2 key questions that I would ask if I were out meeting with business owners. I would ask those 2 questions to start the conversation.
Thank you, Dan.
Yeah,
let's talk a little bit about to what Victor just said. Our producers would love to have the support of LWT and Principal. What can you guys do as we wrap up this session? What can you do to support the producer so they know they have a very strong team behind them and they don't have to know everything about the subject matter they're talking about?
Yeah, so I would say that there are the 2 flagship services that we offer to Leisure, Worden, and Terry on a complimentary basis, I might add, would be the informal business valuation to help a business owner identify what their business is worth. And we look at 5 different methods of valuation. That comes with a business planning recommendations list too for that client. And then the buy-sell review, just again to make sure that buy-sell is fully appropriately drafted and it's not missing anything. With that, because of the partnership that we have with LWT is a policy review. So in pairing that buy-sell review with a policy review, because that's going to help identify if they have that appropriate funding in place and if it's owned in the appropriate place based on the agreement itself. That's a very powerful package to offer to your business owner clients when you're not only reviewing the agreement, but also the funding behind that. And then the last thing I think that I just tack on to what Victor said is if you have a ND purchase or any life insurance policies that are owned by a company taken out after August of 2006 and they didn't comply with 101J, those death benefits may be taxable to the business. And if you weren't planning on that being taxable to the business and you didn't comply with 101J, you may have a shortfall, even if you thought you had, as a business owner, effectively funded your buy-sell agreement. So 101J is another thing just to be monitoring and asking them if they do have corporate loan policies funding their buy-sell, if they're in compliance with 101J.
Yeah, that's an excellent prospecting opportunity, simply asking if they purchased life insurance that is owned by the business since 2006 to make sure they're in compliance. We can do all that review with and for the producer, certainly with your support and team that you have at Principal Financial, Dan. So I ask that the folks listening to the call email us or call us with your questions, because certainly there was a lot covered here, and we can talk about individual cases or some of the concepts that we discussed here. We'll talk with you one-on-one about that later on. But I'd like to say thank you very much, Dan, for your presentation and your support. You guys are second to none in the business markets. It's a fantastic company, great products, great underwriting, and certainly great people in terms of the knowledge level with supporting the life insurance sales in the business market. So thank you for that. Victor, thank you as well. Jim and Mike up in San Francisco, thanks for joining. And for all you who listened in today, thank you. Give us a call if you have any questions. We appreciate your support and we respect what you do at LWT. Thank you.